and welcome. You're watching the Portfolio Managers Show. Devang Mehta, Director, Equity Advisory of Spark Capital Wealth Management joins us. Hi Devang, thank you for joining us. Devang, let's start by talking about a quick view on the broader markets. We thought we were going into a price and time correction, but that's not how things are playing out. There are lack of triggers, but the markets clearly have a mind of their own at this stage. Do you feel like calendar year 24 could beat returns of calendar year 2023?
Thanks, Samina, for having me on the show. It's great to be on NDTV Profit. I think clearly what we feel is that last 6 months, there has been this type of corrections, maybe starting September, October, November, December, Jan, and now Feb. There has been these corrections to the tune of 3-4%, where mid caps and small caps would have corrected a bit more, the indices as well as the individual businesses. But what we have seen is that this falls have been got bought into. And that's the strength. I think it's a confluence of factors, Samina, where there are people coming in with a lot of great liquidity. The domestic investors are still wanting to pump money into the equity markets. The asset class is now clearly distinguished as an asset class where even people are talking about money not going into FDs and coming into sort of stocks and mutual funds and stuff. So that's one important part. Liquidity from Indian markets, from Indian domestic investors is huge. Domestic macros have been sort of very good. Micros have been good. If you look at the interim budget or the vote on account, that also talks about a bit of growth, right? 11-12% growth over a base of 10 lakh crore for infrastructure spend, low borrowing. I think this all has sort of spurred the market in a different tangent, and earnings season, which just came to an end, also actually didn't disappoint it. So I think there are a lot of green shoots there as well. So I probably feel that no, we are in sort of good hands. Whether you beat 2023 returns, that's going to be a bit tough, because in 23 people were started to talk about X returns, right? How many X you would do the money, right? Yeah. Percentages were sort of forgotten. I don't think that type of a market will get in 2024. The rally probably would narrow down a bit. It would be a bit concentrated. It's not the entire broad spectrum of the rally or the market that would now participate. That's the only thing that can happen.
Devang, talk to us about the PMS that you run. I believe it's a non-discretionary PMS. One, what is a non-discretionary PMS for the sake of our viewers who don't know that? What is the assets that you're currently managing, and also what is the minimum ticket? Because most discretionary PMSs are 50 lakhs. So right. Help us understand that. Sure.
So non-discretionary PMS is something where we call it a driver navigator type of a model, where we work very closely with the clients in sort of establishing the investment policy statement with them. We also sort of again get into the portfolio construction or portfolio management or portfolio advising in terms of how the clients want that portfolio to be. Like, for example, is it a diversified portfolio? Is it a concentrated portfolio? Whether the portfolio needs more of a flexi cap or a multi-cap approach, whether the portfolio is only large cap, mid cap, small cap, or micro cap. That's the type of portfolios differentiation in terms of portfolio. Second, I think mutual funds, PMSs, AIFs all have a model portfolio. Here we clearly, of course, we have certain universe of businesses, but there's no model portfolio. The client itself is a model where we sort of design the portfolio in and around his requirements. So that's the in short NDPMS. We currently have around 500 crores of pure play AUM and around say 400-500 crores of family office type of AUM in terms of my non-discretionary PMS, which is called bespoke investment ideas, is what we name it. And I think, yeah, that's about it. And that's the type of NDPMS we run. And here we customize, tailor-made, make a sort of a scientific, holistic approach towards construction of portfolios. And this is purely for a long-term horizon, anywhere between 3 to 5 years. I would love to talk 10 years, but I think the horizons are increasingly shortening. So 3 to 5 years is, I think, a decent time frame where one can probably compound. We call it a wealth creation, more importantly, preservation and senior multiplication strategy.
What is the average number of stocks that your portfolios hold across various risk profiles?
Yeah, so good question. So basically, the newer portfolios where we receive AUM in terms of cash, ideally are anywhere between say 10 to around 18, 20. If I can put a broader number, the average would be somewhere around 14, 15 types, 12 to 15 types. There are certain even legacy portfolios or family portfolios which are probably having even 80, 100 stocks to begin with. There also we sort of take these portfolios and over a period we try and trim them down to businesses which should be sized up. For example, today the bulk of the returns will become when you size your portfolio to a certain extent, right? Buying 50 stocks with 2% sort of allocation everywhere will not take you anywhere. Having 15 businesses and making 5%, 6%, 7%, and letting them also mature in the next 3-5 years, where these stocks can become 2x, 3x as well, and 4x as well somewhere. And to hold that is an art and science, according to us.
So your top, say, 3 to 4 stocks, what percentage of the portfolio do they carry? I want to try and understand how do you split that 100% of the assets?
Yeah, so interesting. So I think just a classic example. Again, this businesses that I hold in the portfolio are not recommendations. They are holdings for our clients. There was a business called Varun Beverages, right? So it's sort of done extremely well since listing in 2016. It is 18x, and some of the portfolios from 2018-19, this stock would have given around 10-12x type of returns. Now, for example, if we would have bought this 4% in the portfolio, 5% in the portfolio, some of these portfolios after trimming down also would have 15-18% type of holding in the portfolio. Now this is, as I said, it's a very concentrated portfolio where we also engage with the clients and say that we feel this business is going to do increasingly better. It's 2 lakh crore in terms of market cap, but whether probably it can touch in the next 3 years 4 lakh crores of market cap, the answer seems to be yes. And then we sort of take a whole decision on even this large position. So yes, some of these businesses are large. Some of these businesses do not perform. Probably we also say that no, this is the time that there are better meritorious candidates sitting outside the portfolio. Why not look at that if this company does not deliver for the next, say, 1.5, 2 years? You give ample time to the management and the promoters to perform very well, but if the business and the commentary is not great, we sort of then get out of this business.
So if you had to build a fresh portfolio with an individual with an average risk profile, so medium risk profile, not high risk, not low risk, you know, a 70-30 equity debt kind of allocation. So you've got the 70% of equity there. Sectorally, what is the portfolio construct that you would build today? What I want to understand from you is what sectors you're overweight on and you'd add to, where there are no valuation concerns, and what you're underweight on at this stage.
Fine. So I think clearly the 3 sectors or 3 themes which we feel will do very well, and this I've been talking about last 6 months, 7 months, are the 3 C's. For operationally, I call them 3 C's. The first C is CapEx. And I know everybody talks about it, the capital expenditure. India has got into this cycle after a hibernation of around, say, 8, 9, 10 years. And we are increasingly seeing government capex, which has spurred the entire, I can say, the infrastructure sector, power, defense. I think all this has done very well. If I count this as a part of capex, even certain building materials, home improvement, all this are part of capex, capital goods. Capex is a theme, one, from the government side. Second, even the private side now seems to be jumping on the bandwagon. There are now announcements of greenfield projects, brownfield projects. So I think this theme, capex, which includes a lot of capital good businesses, a lot of ancillary businesses of capital goods, transformer businesses, energy efficiency. I think this as a theme, if you probably hold, say, 3, 4, 5 businesses in the portfolio, this theme will do well. The second C is credit growth. Now we all know that we are into again a historical credit growth type of an environment which we saw somewhere during 2004 to 8. So credit growth, again, by credit growth I don't mean the run-of-the-mill banks, but there are certain banks, there are NBFCs. Again, credit growth as a theme. There are a lot of microfinance institutions. A lot of such themes can come to the fore. Smaller banks, where I think lending is going to happen very fast. Right now also, if I'm not wrong, the credit growth is somewhere around 15, 16, 17% in the mid and the late teens. So this also has to be an integral part of the portfolio. The third C is which I call consumption, but by consumption I mean more of discretionary consumption, the premiumization trend, the aspirational Indian coming to the fore, right? So where there is, even Maruti talks about this, people don't buy now hatchbacks more, SUVs are a larger part, right? There are waiting lists for the Mercedes and the BMWs of the world. So I think this also discretionary consumption is a theme where people are moving towards luxury. What was necessity, what was luxury earlier is now becoming necessity. That theme also probably 3, 4, 5 businesses over there. This can be a portfolio construct. And of course, then there are niche IT companies, niche technology companies, pharma companies. Probably this 4 or 5 sectors along with 12, 15 businesses should be the order of the day.
Right. And in terms of funds, are you allocating 100% lump sum? Are you going staggered? If you are staggering it, what's the time horizon? How are you approaching the construct?
I think again that depends upon the asset allocation, as you rightly talked about. For example, the private banker normally does an asset allocation himself, right? So a second thing, if I also get into asset allocation or increasingly investing in equities as an asset class, there are 2 things. One, we say that if you are really meaning for the longer term, if you really talk about the next 4, 5 years, I think you can probably do it at one go as well. But yes, if you are a bit skeptical about the markets, and that everybody is, because this will be an eventful year for sure, being US elections, Indian elections, the narrative around inflation, interest rates in the US. So I think, yes, probably you can phase it out over the next 3-4 months. You will probably, volatility will come and disturb you, but it will become a friend if you're a long-term investor. So you can do it in a couple of tranches, 3 tranches if you are a conservative investor. But if your horizon is 3-5 years, and if you are trusting that the Indian economy and Indian markets, or rather the businesses that we are picking with a lot of conviction would bear fruits, I think we can probably do it at one go as well. But ideally, yes, to be safe, a couple of tranches at this levels of the market or at this valuations would be a little bit more comfortable for everyone.
Right. Let's talk about a few stocks that you seem to like, and I think Hitachi is one such. Hitachi Energy is one you like. Now, this stock is not a very large company. It's what, 25,000 crores of market cap. The stock trades at 21 times. The return on equity has also been fairly low for the last couple of years. So what makes you constructive about Hitachi, and would you add incremental money to Hitachi is what I want to know.
Yes, so this business has already seen around 4, 5, 6x from our buying prices over a period in the last 3-4 years. The biggest trigger for this company, the history is that there was a company called ABB, which is still there. This company demerged as an entity called ABB Power Product. Hitachi, a global giant, came and took it over. Now this company is into everything, right from power automation to grid integration to transformers to power data centers, and it's an annuity model. It's a high niche type of a business that it is into, and you can call it as a power ancillary business or an energy efficiency business. It also sends robots to the transformer and checks the oil efficiency, and when the oil is getting over. It also does something which is very interesting, that today there are so much different types of power. For example, solar or wind power or even your thermal power. It differentiates between what power is getting generated, what is the unit per power cost. There's a software called Lumda which it uses for doing this. Now I'm talking a lot about this. The EPS somewhere right now would be around say 35-40 rupees. In the next 2-3 years, the EPS probably would reach a 140-142 type of level. All the orders of the larger companies, capital good companies, infrastructure companies flow into Hitachi Energy. So this is again as a proxy play, a big theme to play the capex or the power efficiency story, or even a renewable story. Somebody playing an EV. This lays down the infrastructure for electric vehicles as well, along with BP, IOC, HP.
Right. Thank you for that, Devang. Great talking to you today and discussing about the markets and your non-discretionary PMS. With that, we'll take a quick break. We'll come back. There's a lot more on the other side, so stay with us.